You've now had a good look at the ABA program and what it does. One of its biggest advantages is the automated features it has. You'll remember as we worked through it, you entered a lot of detail, and that makes it now very easy to look at alternatives in different scenarios. First of all, we'll look at the year-end macro function. You will remember seeing the year-end macro button on the title page. The purpose of this function is to allow you to create a document for a subsequent period without having to re-enter all the detail. That way, when you've created a document for a certain time period and the next period comes along, the document can be recreated with a minimum amount of input. This is the process. This is the title page showing the location of the year-end macro button. These are pages before the year-end macro is run. Next are pages after the macro is run. You'll see that some of the information has been removed. On these pages you can see that the information that was in has been moved over one column to the right. The change allows the user to then re-enter the new detail for the next time period. Next, we're going to look at some change scenarios. As mentioned, when the original entries were done, a lot of detail was provided, and that sits in the background, allowing for detailed change scenarios to be easily done. I'll show you an example on the liability statement. If we look at the loan to Uncle Joe, the number of years left is 5. The principal outstanding is $300,000. So the payment amount is $60,000 a year plus interest. And it's principal plus interest because it's a fixed loan. With those repayment terms, remember some of the financial indicators are marginal. If we go to the debt service summary page and look at payment requirements and budget surplus, in year 2, the budget surplus is $3,839. And that's on a debt service capacity of $270,863. So it's a very marginal surplus. Then if we go to the risk ratios page, you'll see the projected debt servicing ratio is 1.01, reflecting the marginal debt service capacity in the projection. Let's go back to the term liabilities page and change the number of years left on this loan from 5 to 10. You'll see that the payment amount changes then to $30,000, and that would be again $30,000 of principal plus interest. And that change happened automatically because of the detail that we have entered into the program. If we go to the debt service summary page, we can see that with this change, the budget surplus increases to $34,648, and it was originally $3,839. So it's a substantial difference. And the difference is reflected in that reduction in payment requirement. And then let's look at the risk ratios page. With the change in payment requirement and the budget surplus, the debt servicing ratio is now 1.15, whereas before the change, it was 1.01. When you make changes, the calculations all follow through as they did in this example. We can look at other pages as well to see how this change impacts on them. In addition to this, other changes could easily be made too, such as prices for crops and livestock sold, expenses, etc. I'll now show you a more complicated scenario change. Because of the automated features, you can do virtually anything in a scenario with the ABA program. Scenarios seldom require a lot of changes. Only the things that need to be changed are things that you're going to have to change when you do the scenarios. I'm now going to show you a scenario based on the example that we've been working with. Remember, in that example, debt service capacity was marginal and some of the financial indicators were weak. So in this example, the farmers are going to sell the lake lot for $180,000. They're going to retire Uncle Joe's debt. They're going to require the B of A mortgage. And they're going to refinance with a new loan, $1.4 million at 4.5% interest, with annual payments starting December 15th and the loan is going to be advanced on March 15th, 2015. First of all, we'll go to the term liabilities page, and we'll retire the Uncle Joe loan. Now we're assuming that the financial things are going to happen on March 15th, 2015. So in column W, the retire loan column, we'll enter March 15, 2015. Then we'll go to column V, the retire loan column. We'll click on the cell in that column for the Uncle Joe loan, and we'll click on the retire loan macro button. You'll see the amount that comes up is $300,000, which is the amount to retire Uncle Joe's loan on March 15th, 2015. There's no interest in this case because this is an interest-free loan. So the retirement amount is principal only. Next, we'll retire the B of A mortgage loan. So again, we'll go to column W, the retire loan column. There's a date of February 1, 15 in there because originally the plan was to pay the arrears that are outstanding on that date. But now we're going to retire the loan, so we'll change this date as well to March 15, 2015. Then we go to column V, the retire loan column, click on that cell for the B of A mortgage loan, and then click on the retire loan macro button, and it will calculate the amount to retire this loan on March 15, 2015. And you can see that it includes accrued interest. Next, we'll go to the new term liabilities section in the bottom and add the new financing. So I'll make the entries for the new term loan. The name we're calling it is New Term Loan. For the last payment date, we'll just look at the comment box and see what it says. It says the last date that interest will be paid on the loan in the upcoming year. So in this case, the date we'll put in will be December 15th, 2015. It's going to be a blended loan. The interest rate is 4.25. It's going to be compounded semi-annually. The amount we're going to borrow is $1,400,000. We have a 20-year amortization. The payments are going to be annual. So with that information, when we come to the payment amount column, we can just click on the macro button and it calculates the payment automatically at $105,724.73. Then we need to move along and complete the rest of the information for this loan. The loan advance date is going to be March 15th, 2015. And the first payment date, which is going to include interest and principal, will be December 1st or December 15, 2015. With that information, we've got everything in that the program needs for the new loan. Next, we're going to sell the lake lot. To do that, we'll need to go to the cash flow summary page. That's the CF Sum tab. You'll see the lake lot shown under long-term assets, $180,000. And you'll remember when we were doing the asset debt net worth section and we were in the other assets page, we entered the lake lot at that time as $180,000. Now it's going to be sold, so the $180,000 is going to be cashed in March. So we'll go to the March column and enter $180,000. That brings that $180,000 into cash. With that, the entries for this scenario have been made. We've retired those two loans, the Uncle Joe loan and the B of A mortgage. We've added the new loan for $1.4 million, and we sold the lake lot. And we're having this all happen March 15th of 2015. Now let's go to the cash flow page for term liabilities to see if the things are happening to the debt the way we expect them to. So if we look at the top, we can see the new term loan of $1,400,000 coming in March. And that's as expected. And if we go down to the next section, the term loan payments for new term loans, we can see our new term loan and a payment of $90,898. And that's going to happen in December. Now you may wonder why it's this amount and not the $105,000 that was calculated when we entered the loan on the term liability sheet. The reason is, for the first payment, there's only 9 months of interest. Remember, the loan is going to be advanced in March and the payment comes in December. So in the first year, there's only going to be 9 months of interest in the payment requirement. Now in the long term, the annual payment will be the full amount. So this is another case where we may want to look at the year 2 numbers in the debt service requirements. Next, let's look at the debt servicing summary page. So if we look at the bottom at the debt service requirement and the budget surplus, we can see that both of those have greatly improved. With these changes, the payment requirements have dropped from about $267,000 down to $200,000 in the first year and $208,000 in year number 2 when the full payments kick in. The budget surplus has gone from about $3,800 up to about $70,000 in the projected year and $62,000 in year 2. Lastly, let's look at the risk ratios page. On this page, we see great improvement from the original example. The debt servicing ratio is now 1.3, whereas originally it was 1.01. And other ratios follow suit. Because of the lower payment amount, the ending current ratio is going to be much improved. If we look at the cash flow summary page, with the lower payments, we can see that operating loan requirements are reduced as well. Let's look at some side-by-side comparisons. On the left-hand side, you can see the debt service summary sheet before the changes are made. On the right-hand side, you can see them after. The reduced payments are shown and the improved surplus. Looking at the risk ratios pages before and after and comparing the results, we can see the improvements. And again, as mentioned, the cash flow improves in this scenario. At the top, we have the before situation. At the bottom, we have the after situation. And we can see the reduced operating loan requirements. This ends my overview of the ABA program. Thanks for watching the video series. If you need more information or assistance, please refer to the user guide or the contact information on the Alberta Agriculture website.